Hi, I'm Lindsay Bennett, Healthcare Executive. In today's video, I am going to show you how people game and manipulate a very important finance and revenue cycle metric, which is days in accounts receivable or days in AR. Now, the purpose of this video is not to teach anybody how to game numbers or to cheat. In fact, if you're watching my YouTube channel, or if you've read my book, or if you've taken any of my healthcare finance or revenue cycle masterclasses, then you have the tools and the strategy to be able to move the metrics in the right direction legitimately. That said, if you are a physician owner or an auditor or a board member or a revenue cycle leader, there are some things that you should be aware of that people do to manipulate these numbers. Now, if you didn't watch my previous video on how to calculate the days in AR and the mistakes that people commonly make, you should check that out. Before I tell you the very specific ways that people manipulate days in accounts receivable, let's talk about financial metrics in general and how those numbers move and how people manipulate them. So the way that I go about understanding any financial metric is to look at three components. There's the output, which is the number itself, and whether you want that to be a bigger number or a smaller number. And that depends on what it is. In the case of days in accounts receivable, you want a smaller number because you want the shortest number of days that it takes to convert a service into cash in the bank. If it's days cash on hand, you want a bigger number because you want a lot of days of cash on hand to meet your expenses. So the way I go about understanding things is to simply model out, even on a scrap piece of paper with a pen, if my numerator goes up or down, what does that do to my output? And if my denominator goes up or down, what does that do to my output? And once you understand those things, then you understand how to move any financial metric, including days in AR. And you can also imagine some ways that people might alter the assumptions, such as a definition or a time frame, to make the numerator or the denominator go up or down in a way that makes that output more favorable looking. Now let's get into the specific ways that people manipulate days in AR. The first is holding claims. And what this does is that it artificially reduces that numerator, making the days look better. And the way that people do this is that they will leave claims in a discharge not final billed status, or in a hold for review status, or some kind of status where in the EMR system, it doesn't yet flow to the accounts receivable balances. So that will deflate that numerator. The second way that people manipulate days in AR is to do mass write-offs right before reporting it. And that could look like contractual allowance write-offs, timely filing write-offs. It could be taking a big chunk of older accounts and sending them out to the collection agency. And what that does is it lowers the accounts receivable balance in your numerator, making your days look better. So the way that we avoid this happening is that we look at our days in AR in conjunction with write-off reports and in conjunction with collections percentages. The third way that people manipulate days in AR, I touched on in my previous video on how to calculate it. And that is whether you are using net numbers or gross numbers. And it doesn't matter which you use, but it matters whether you're consistent between your numerator and your denominator. This metric is to not be consistent in whether they're using net revenue or gross revenue, or net AR and gross AR. So you can imagine what would happen if you were using your accounts receivable balance stated as being net of contractual allowances in your numerator, but in your denominator using your average daily gross revenue. Well, in that case, you're bringing down the numerator, increasing the denominator, and your days look better. The other thing that I cautioned against in my other video on how to calculate the days in AR is the credit balances. By leaving a lot of credit balances accumulating on the aging, what that does is it puts a bunch of negatives in that numerator, brings down the AR balance, and artificially makes your days in AR look better than they are. And then finally, another way that people manipulate this is by cherry picking a time frame to calculate the denominator. If you'll recall, the denominator is the average daily revenue. So you could take a year's worth of revenue and divide it by 365 days. Or if you're in a really seasonal organization, let's say, for example, that you have a medical practice in Florida where your volume goes up 30% in the tourist season from Thanksgiving until Easter. Or let's say that you operate an urgent care clinic off in a ski town where people come in and ski and get hurt during the winter season. If you were to just take the months where you have higher revenue during peak season and use those to calculate the average daily revenue, then that would also make your days look better than they would be on a larger time frame. If there's anything I missed, please put it in the comments below. Hopefully this video was helpful to you. Please check out my other videos on healthcare finance and revenue cycle topics.